Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So in this video, I'm reviewing some recent research from Morgan Stanley who've now upgraded their Tesla stock price target to a whopping $880 per share. Good job, guys. So let's get into the video. But first, hey guys, if you'd like to help out the channel and get up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $250 just for opening an account. And if you fund your account with $100, you'll get a second free stock valued up to $1,600. Unless you don't like free stocks, that is. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake also using the link in the description. Let's get back to it. Tesla Inc. Growth is the best defense. Price target to $880. We updated our estimates and price target following Q4 results that featured weaker margins, a stronger balance sheet, and higher, more aggressive growth objectives. I just have to jump in here, by the way. There are no more aggressive growth targets or objectives. Nothing increased. Tesla just reiterated their plans to continue to, on average, produce about 50% more vehicles in the following year than the year prior over a long period of time. This isn't new information, just putting that out there, but whatever. We raise our target to $880 versus $810. We reiterate the overweight rating and position Tesla as a core EV portfolio holding. Elon Musk emphasized the importance of growth in its core EV market and conveyed the role of rapid capacity expansion coupled with vertical integration down to the battery cell in protecting the company's leadership position in the market. As we illustrate in the below double flywheel, growth is key to expanding the installed base, driving a greater contribution of regularly occurring and higher margin adjacent business opportunities. Just jumping in here, for example, selling video games through the Tesla App Store, these kind of things, upgrades, over-the-air infotainment, this kind of stuff. Once you've got a vehicle out in the marketplace, because of Tesla's software prowess, it's not game over. It's not just, okay, I bought a vehicle, you're never going to see future revenue from me again. It's a case of, okay, now that Tesla has this customer in one of their vehicles, what are ways that they can further monetize in the future? And basically the answer to this is almost exclusively high margin software revenue. Whether it's information, entertainment, gaming, productivity, etc. These are the kind of things that Morgan Stanley are getting at. This helps Tesla's valuation to expand far beyond the scope of a typical automotive manufacturer because of course they're not. Mr. Musk targets a 50% top-line compound annual growth rate over a multi-year period. Our auto unit volume forecasts imply a 27% compound annual growth rate through 2030. I just want to jump in here. Tesla themselves are aiming for about a 50% compound annual rate of growth for the next 10 years. Morgan Stanley are expecting about half that at 27%. Who do you think is going to be right? Just asking. Holding all else equal, if we were to run a scenario of a 50% compound annual growth rate through 2030, our hybrid DCF valuation model would rise in excess of $3,000 per share for Tesla. Just so you guys understand, they're now at $880, so yeah, there's that. To be clear, we are not prepared to treat such a scenario, even within the scope of our bull case at this time, and believe there is much for investors to explore in many of the non-unit based auto business lines, such as insurance, energy, third-party battery supply, autonomy, and network services revenue. Now again, I have to jump in here. Okay, Morgan Stanley, if you're not willing to accept Tesla's own internal plans based on first principles, fundamental analysis of how quickly their production capacity can expand, etc., you do you. But I will be here to laugh at this forecast in a few years' time. So just taking a closer look at Morgan Stanley's Tesla Auto plus Network Services double flywheel here, over on the left in the auto flywheel, we can see that as capacity expands, costs come down, prices therefore come down. That means sales increase, profits increase. Tesla can then use those increased profits to drive down the costs, improve the design, etc. Capacity increases, costs come down, blah, 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 blah. This is a great feedback loop. Basically, the more vehicles Tesla can produce, the cheaper they'll be able to produce those vehicles for, the better those vehicles will become over time, the more people will be able to buy them, and so on. And the second flywheel over here, the software as a services flywheel, relating to all of the customers who have an existing Tesla who now can produce high margin software revenue for Tesla over time. We can see here as software services revenue increases, Tesla gains more insight, more data, etc. They can improve the user experience further, for example, improving full self-driving, creating games, apps, productivity, infotainment, education, etc. That means customers are sticking to the platform longer. This can increase affordability, the monthly user base continues to increase, and so on. These two flywheels together basically, in short, mean that Tesla is going to be printing billions and billions of dollars of extremely high margin revenue from its install base. So it's not just the upfront revenue that Tesla makes from selling vehicles here over on the left, but in the future, each of those vehicles is a user who in the future can be purchasing software, apps, upgrades, etc. This is an incredible situation to find yourself in, and one of the reasons why everyone's so excited about Tesla's future software revenue. Unit volume trimmed slightly for 2021 to 785,000 units versus 792,000 previously to reflect low inventory, continued COVID disruption, and a margin of safety for up the supply chain disruption from microchip shortages. Longer term, we raised our 2030 volume assumptions to 5.38 million versus 5.23 million previously on the back of assumptions for slightly more aggressive capacity expansion. Okay guys, we're going to take a break here. Can everyone at Morgan Stanley who was involved in this Tesla research please take your dominant hand, that's this one, and use that to repeatedly punch yourself in the face. Now, let's do some math to explain why this is embarrassing, and honestly, the people that wrote this research, morons. Should be renamed to Moron Stanley. I mean, really, let me explain why. Alright guys, so most of you have probably never seen one of these before. This is called a calculator, and you can use it to calculate things. So let's calculate some information about Tesla's production capacity based on all the available information today. We're going to use some rough ballpark numbers just to try to illustrate why Morgan Stanley or Moron Stanley are absolute idiots and don't know what the f*** they are talking about. Now, I don't know how to say this kindly, like if I could be more gentle I would, but I really just want to punch myself in the face for how moronic these numbers are. Let's see why. Fremont's capacity today is around 600,000 units per year. Tesla has told us that Gigafactory in Shanghai is going to produce over 1 million vehicles per year long term. We're now at 1.6 million. They've also told us that Berlin's going to produce around 2 million vehicles per year. What about the Austin factory? Well, it's a ton larger than the Berlin factory. Let's be really conservative though and assume it's only going to produce 2 million vehicles, the same amount as the Berlin factory. Oh shit, we're already at Morgan Stanley's 2030 production capacity target for Tesla based on the factories that they currently have operating or under construction and expanding. So, Morgan Stanley, I ask you guys the question, how do you have a job? Seriously? Like, who is doing this research? Already got enough production capacity in the near term to reach your 2030 target. Do you really think Tesla's not going to make any more factories, not going to construct any more factories between now and then? I just don't understand how anyone could put their name on this research. Like, what are these Muppets doing when they're sitting together going, okay, Tesla's going to reach 5-point-something million units in 2030. Hey guys, what if they build extra factories between now and 2030? Wouldn't that mean that... Shut up. Cool, yeah, Tesla won't build any more factories between now and 2030. They'll just continue expanding the ones that they're already making. Yeah, that makes a whole lot of sense, you fucking idiots. Now please, don't get me wrong guys. There's nothing personal here. I've just got to call a spade a spade. This research is just embarrassing. I mean, that being said, it's perfectly possible to be a complete fucking moron and a good person simultaneously. I hope that's the case with the Morgan Stanley researchers behind this embarrassment of a report. I think what's going on here is reasoning, and I use the term reasoning extraordinarily loosely, reasoning by analogy versus first principle. Morgan Stanley, if they're to believe Tesla will achieve their own internal goals, come up with a ridiculous, unprecedented $3,300 per share price target. Ludicrous. No company's ever been that valuable. No automotive manufacturer's ever grown that fast. Not possible. Let's completely disregard all the evidence. Tesla's own, yeah, forget about that. We've never seen anything like this before. Therefore, it's not possible. Therefore, Tesla, sorry, we don't believe you. Well, Morgan Stanley, I've got to say it one more time. I mean, you guys are serious morons. Tesla's going to have the production capacity you're expecting in 2030 in a few years' time. I mean, how else can I say this? This is very obvious. What are you thinking? Oh, that's right. You're not thinking. I'm sorry, guys. I got a bit carried away. I just have this intense aversion to stupidity. It just grates me. Morgan Stanley are expecting Tesla's automotive margins to be around the mid 20% range or so over the near term, and long term closer to the low 20% range. In my opinion, I find this unlikely. It is possible, but Tesla continues to drive their costs down. We recently heard on an interview with Elon Musk and Sandy Munro that the gigantic rear casting for the Model Y has deleted 300 out of 1,000 robots on the production line. The front's going to delete another 300. The rate at which Tesla can produce vehicles and the cost for which Tesla can produce vehicles continues to come down over time, and there's no end in sight. So if Tesla continues to drive the cost of their vehicles down, they've got two options. They can cut prices increase margins, or a combination thereof. This is a lever that Tesla has complete control over. The question is, will they try and sell as many vehicles as fast as they possibly can to expand their install base, or will they maintain slightly healthier margins, use some of that profitability to increase their scale and produce more vehicles over the long term? This is totally up to Tesla. I think Morgan Stanley being very conservative on Tesla's long-term margins, but hey, whatever, this isn't really that meaningful. Why? Because it's the software margins, the software revenue that really matters, and that is going to explode. Here we are looking at the 3 different price target scenarios for Tesla stock from Morgan Stanley. The bull case, $1,272 per share based on only 8 million vehicles sold by 2030, well under half of Tesla's target. The base case, $880 per share based on a piddly 5.4 million vehicles sold in 2030, a quarter of Tesla's goal. And the bear case, which is such a joke, we're not even going to discuss it. This is possibly my favorite graphic from the entire report from Morgan Stanley. The Morgan Stanley estimates versus the consensus opinion. As you guys have probably realized by now, I think Morgan Stanley are enormously underestimating Tesla. Yet look at this. Morgan Stanley's estimates are considerably above the Wall Street consensus. What does that tell us? The Wall Street stock analysts, on average, have absolutely no idea what the fuck they're talking about when it comes to Tesla. But you guys already knew that. After all, they've been dead fucking wrong for the past half decade or so. Suddenly Tesla stock's headed to the moon and they're all scrambling trying to figure out how they were completely wrong, yet still unwilling to look at the evidence and instead reasoning by analogy rather than first principles. I'd love to know your guys' opinion, so let me know in the comments below. Who do you think is more likely to have an accurate idea of how many vehicles Tesla will actually produce in the year 2030? The geniuses over at Morgan Stanley, or any of the Wall Street stock analysts for that matter, or the CEO of the company, Elon Musk? Let me know in the comments below. Elon or the analyst? Who do you think's got a better idea? In my opinion, what we have going on here is an enormous disconnect between reality and opinion. What Tesla will actually do versus what the consensus thinks Tesla is capable of achieving. Now, in my opinion, every one of these Wall Street analysts, bar the 1 or 2 outliers who are very bullish on the company, are going to be completely embarrassed by their forecast of what Tesla would do in the future. And so they should. With the available evidence today, for a firm on Wall Street to be expecting Tesla in their base case to deliver around 5 or 6 million units in 2030, they should be mocked and ridiculed and out of a fucking job. Of course, I could be wrong. The great thing is, the internet never forgets, and this video will be here in 2030 when I'm not. I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. And don't forget, if you'd like to help out the channel and get up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $250 just for opening an account. And if you fund your account with $100, you'll get a second free stock valued up to $1,600. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake also using the link in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.